In this second video, we'll be talking about some additional problems that you'll have to do in Connect, as well as an additional problem that relates to dollar value LIFO, which does not have to be done for your assignment, but is something I think is important to know about, and we'll be talking more about in Chapter 9 as well. As we've talked about in the previous video and in previous courses that you've had, it's really important to continue to update your balances as you go. So in the previous video we talked about running through costing methods under FIFO and LIFO. We talked about the reserve account. And then I also went through and discussed the way in which we cost under FIFO. And it's always important to maintain the balance of your inventory, and then what are the components of that balance. So for example, we have $595,000 here. It's important to kind of break that down based on the number of units per cost, and then be sure to take out the discount when we're costing the inventory, and then add in the freight. So be sure to kind of break down the components of your balance as you go along. And as we move forward, that'll be something to remember as we move forward to the next problems. This one is problem 8-10 in your textbook. And problem 8-10 in the textbook is found on page 450 on the top. And this is a LIFO liquidation, so there's some new information here. The costing methods are not new, we've done that before. But we're going to talk a little bit about the impact of the LIFO liquidation. And when we get into Chapter 9, we're going to go into that much deeper. That idea of the impact of LIFO liquidations, as well as how to prevent it or reduce its impact or effect on our financial statements. To start that conversation, then we look at problem 8-10, and we have units purchased and units sold. In this case, we're using last in, first out. And as you can see, in addition to the formulas that I have listed in the yellow and gray cells, I've also broken it out separately on the side here to show the sequence of events and how we costed our sales going forward. So that too is a review for you, but let's take a look. We have the first requirement, and they're really asking us for the value of the units sold, or the cost of goods sold is another way of saying that. Well, if we look at the first transaction under last in, first out, we've got this sale, and the sale then is for a total, let me get the sale here, a total of 14,500 units. First transaction 2, transaction 1, we have 11,000 units, and then the last transaction will have 13,000 units. So let's cost these out individually. Let's go to the first sale. We have the 11,000 units. So under last in, first out, we're going to look at the components of the previous balance. And actually there are two of them in this beginning balance. We're going to go to the most recent cost. Well, the most recent costs first are the recent purchase. So of the 11,000 units, 10,000 will be costed at $18 because that was the most recent purchase. Then we need an additional 1,000, and we're going to go back to the beginning balance, and we're going to grab 1,000 of these 2,500 next most recent purchases. And so we'll have 1,000 units at $16 to add to our 10,000 at 18 under LIFO, and our cost of goods sold is $196,000. So I have it listed out here in the chart, as well as in the formulas to the left here in these cells. Next sale occurs, and we have again made another purchase, the 13,000 again, all at $18 a unit, and so in this cost of goods sold for the second sale, we need 14,500. We are going to go back, and we're going to grab 13,000 of the $18 that we just purchased. So that's the most recent purchase. So of the 14,500, 13,000 will be at 18. Then we have to go back, and we're going to pick up the other 1,500 at $16. That's the next most recent purchase. And add those two together, 1,500 times 16 plus 13,000 times 18, and our cost of goods sold is 258,000. And we'll use the exact same method for the last sale. So that's another review then of the LIFO method. However, what is a little new to us is this additional profit for the LIFO liquidation. And what would the additional profit be on using the LIFO method? The additional profit occurs because when we costed each of these sales, we did not use entirely the most recent current cost of $18. We had to go back and pick up old costs, lower costs, in this case assuming inflation. And that means that that's going to increase our profit because we're using older, stale, lower costs. That's the additional LIFO liquidation profit that we're talking about. So let's run through a calculation here. In this case, the way I calculated the additional profit by using these older, lower costs, the difference between 18 and 16, the old cost is $2. 18 minus 16 is $2. That's the additional profit, $2 per unit times this 1,000 units. Let's just take 18 minus 16, current cost minus old cost, and then multiply it by the number of units we costed under the old cost, which is 1,000. So $2 times 1,000 is $2,000. That's the additional profit that we're realizing because we've liquidated an old layer. And it gets worse. If you move down into 2022, here again I took the 18 minus 16, the current price minus the old price times the 1,500 units that were costed at 16. So 18 minus 16 is 2 times 1,500 units is $3,000. So that's the additional LIFO liquidation profit. And then finally, the third LIFO liquidation profit. Here again, we're going back even further now. We're taking $18 current cost minus $12 because we had to reach all the way back to the very beginning to get those last 1,000 units of cost. So 18 minus 12 is $6 times 1,000 units that were costed at $12, and we wind up with 6,000. So that's that additional LIFO liquidation profit. It violates the matching principle because we're not matching current revenue with current expenses. We're matching in part current revenue with old expenses, perhaps even from previous years. And that's going to distort our profit. And we'll talk in Chapter 9 about ways in which we can help to reduce or lessen the LIFO liquidation effect. In brief exercise 8-6, this is another exercise that you had to look at. This one, we're not looking so much at LIFO now. We're looking at FIFO and the average cost method. This is just a review for you. There's not a lot of new information. You've done all of this before. A couple things to note. One is that we need to know if we're going to cost under perpetual or periodic. And that's especially important under the average cost method. Because under the average cost method, under perpetual, as you can see, we need to continually recalculate our average. So right before each sale, so our first sale here is on January 10th, the question is, what is the average cost per unit times 125 units that we sold? Well, we have to calculate that $26 per unit by taking the total amount we had available to sell and divide that by the number of units. And so we had the $2,800, $2,800, and that $2,800 is divided into the 7,800, and we wind up then with under the average cost method, we need to calculate, especially with the perpetual method, we need to continually recalculate the average cost before each sale. So I've done it in two ways. I've done it in the formulas where I'm costing under FIFO and the average method, and then I've broken them out separately here. FIFO, we just went through an example earlier. I won't go through the the calculation method here, since you can review the previous portion of the video. But the average cost method under perpetual, we might do a little review quickly here, and that is that we need to recalculate the average every time we make a sale. So in this case, we sold 125 units on January 10th. So what's the cost of each of those units under the average method? Well, we're going to take the $5,000 value we had plus the $2,800 additional value from the purchase, and that's going to give us $7,800. We're going to take that $7,800 and divide it by the total number of units that are available, which in this case is 300. 200 plus 100. And that's going to give us our $26 per unit. That will be the cost of this sale. And then we repeat that process going forward. So in this case, we had another sale on January 25th of 100 units. So how did we arrive at the $28.13? Well, in this case, again, it's a new calculated average because we had another additional purchase of 200 units at $30 since the last sale. Well, that's going to impact then our average. So the way we calculate this is we're going to go back as far as we can, and we're going to again add up all of the costs, 5,000, 2,800, and then this new 6,000. And then we're going to deduct the cost of that previous sale of $3,250. And then we'll divide that into the total number of units we have available, which again is 200 plus 100 minus 125 sold plus 200. And we wind up then with 10,500 divided by 375 units. And that gives us our average of 28.13. And again, feel free to stop and replay the video to review that calculation. And then we're able to arrive at our final total cost of goods sold. So that's the only new part. It's actually something you've done in the past, but at least in this course, it's a review of something that we have done before. So I think it was worth going over, especially on the perpetual method where you need to continually recalculate the average. And then, of course, the value of the ending inventory under each method, FIFO and LIFO, is just the total value you had available less your sales, less your cost of sales. And that will give you then your ending balances. And then finally, this is something entirely new. This was not assigned. We will be picking this up more in Chapter 9, but I just wanted to run through this dollar value LIFO. The dollar value LIFO is one method we can use to reduce the impact of LIFO liquidation. That is, the impact it has on our reported net income and operating income. So in this case, we use what's called a price index, and a lot of times the CPI or the consumer price index is used. And essentially, we're going to use that index to deflate the ending cost of our inventory back to some base year. So in other words, our reference point will be a base year. And then from that base year, we're going to continue to make adjustments to inventory using this cost index. In this case, consumer price index. That'll help to reduce the variability of our income when LIFO liquidation occurs. So let's walk through this problem. Again, if you're following along, it's exercise 8-28 in the text. Again, not found in Connect. This is not assigned this week. So we have a value of our inventory pool, and that's just pooling a variety of inventory items together to, again, reduce variability of costs. And we have 720,000, and they tell us that it's as of the beginning of the base year. That's important because that means that this is our starting point. This is our base. So the price index at our base time, which is January 1st of 2021, is going to be 1. In other words, there is no inflation yet, or there is no price changes, consumer price index yet, because we decided we're going to start completely new this set of calculations on January 1st, 2021. They also tell us that the consumer price index was 240, or a factor of 2.4. And then by the end of the year, of our base year, it was up to 264, or 2.6. All right, so we have then our indexes, and so we need to look at the change from the beginning of the year, our base year, our jump-off point, and the end of the year. And we do that by taking the difference between 264 and 240 and dividing it by 240. So 264 minus 240, and then we'll divide that by 240. And that turns out that during the year we saw a 10% change. So from the beginning of the year, the index was 240. To the end of the year, the index was 264. That's a 10% increase. We add that to 1, and we have a factor during the year then of 1.1. Now, a lot of times in your calculations, for example, in Chapter 9, you won't need to make this calculation because the factors will all be given to you. But this is nice because we're able to determine the factor based on the change in the price index during the year. So that 1.1 or 110% is key. All right, so that's the consumer price index change for the year. Now, one of the things we need to do in this dollar value LIFO method, and they call it the DVL, dollar value LIFO. Again, it's designed to reduce the impact of liquidation of LIFO layers. So the approach is this. Since our base year is 1/1/2021, we're going to take that inventory value, divide it by 1, because the index at that very first day, January 1st, is 1. There has been no time yet elapsing in the year over which inflation could have occurred. And if we're starting at 1/1/21, no inflation could have occurred, therefore there's no change. Our first layer is $720,000. So we multiply that by 1, and the layer remains at 720, because that's the base year. That's our starting point. Now they're saying that at the end of the year, we had $880,000 of cost of inventory. So we went from 720 to 880. However, in order to reduce the LIFO liquidation effect, we're only going to apply this price increase during the year of 10% to the new value in the layer. So I know that's a little complex, but let's walk through it. The first step is to deflate this 880,000 back to the beginning of the year value. So if we take the 880,000 and we divide it by the index this year of 1.1, we're going to land at $80,000. So essentially what we're doing is we're restating the 880 end of year value to what it would have been had we had no inflation at all during the year. In other words, the base year or beginning year price. So we've essentially deflated that 880,000 down to what it would have cost us at the beginning of the year. Now we're comparing apples to apples because now we look at the 720 and we've moved up to 800, but you notice that we are now changing values from 720 to 800, and as though they both occurred on January 1st. No inflationary effect here. Well, if we have a total then at base year value of $800,000, then we need to bifurcate it or separate out the layers. Well, we know we have the first layer at 720,000 because we calculated that earlier. Now we're going to compare that 720 to our 800,000, which is the end of year value deflated back to the beginning of the year, and we see a net increase of $80,000. 720 plus 80 is the 800. So now we've got the two layers at the end of the year. Here's the change then. We're going to only apply this inflation during the year to the new layer. In other words, the new layer and only the new layer will be affected by inflation this year. The base year amount, the 720 of this 800,000, will not be affected by inflation. Therefore, we have an end of year inventory value, dollar value, LIFO cost of $808,000, which is the addition of 720 plus 88,000. And that then is our inventory at dollar value LIFO cost. If you have any questions on this method, we'll review it again in Chapter 9. So, don't feel too overwhelmed with this yet. But just remember that the cost index sometimes needs to be determined, but most of the time we'll just be given the index each year. And then we're going to start this process all over again. We need to set a base year, and we're going to set all prices to this base year. And then any new layers will be costed at inflation. And if we start liquidating layers, we're going to liquidate them at their proper cost, their deflated cost. But at least at this point, it's enough to know the general method of using dollar value LIFO to overcome the negative effects on financial reporting of LIFO liquidation.